Hi, everybody. My name is Lee Schwartz, and I am the Director of Business Development for SVA Certified Public Accountants. I'd like to welcome you to part 2 of our Economic Impact webinar series. Today's topic is creating agility with key indicators and strategies. Now, before we get started, I just want to take a sec and say a few words about SVA. Our vision is to remain independent, and our goal is to continue serving the same clients we have since 1974. Closely held businesses, family-owned businesses, nonprofits, and high net worth individuals. And our mindset is that when you're a business owner or shareholder, that business is more than just a job. It's going to affect you personally. So it's really important that your advisors are not just about compliance, but they're working with you collaboratively on a consultative basis. And that's our goal. Now, this webinar and others like it are just one small way in which we do that. Before I bring in our speakers, let me just talk a little bit about the format today. Those of you who were around for part 1 of the series know that we had a very conversational format and stayed away from a PowerPoint. But we got a lot of feedback saying, that's great, stick with that unstructured format. On the flip side, we got the equal amount of feedback saying, where's the structure? We need a PowerPoint. So I guess the takeaway is you can't please everybody, but today's topic does lend itself well to slides. So that's what we're going to have today. If you have questions during the webinar, please chat them in. We will do our best to address them at the end. So let me introduce our 2 presenters, and they're the same ones from last month. First off, we have Nancy Melbert out of our Brookfield office. Nancy leads our Management Advisory Services group. And we also have Nikki Grollup out of our Madison office, who leads our hospitality industry group. Both Nancy and Nikki have diverse client bases covering many different industries. So they'll be able to bring some great perspective to these topics today. So without further ado, Nikki, I'm going to let you kick this thing off.
Thanks, Lee. Looking forward to it. So today we're going to talk about forecasting in an inflationary economy, creating budgets with increased pricing and supply chain issues in mind, using key indicators to create agile business plans, and metrics you should continuously monitor. So with that, let's jump in and talk about forecasting and budgets. Oh, first we're going to do a poll question. So how often do you create budgets? Monthly, quarterly, annually, or what is a budget at all? So we'll wait for a minute for people to respond. All right, so we have 5% monthly. Nobody does a quarterly budget. 81% annually, and 14% what is a budget at all. So I think we have some real good content and looking forward to it. So let's jump in and talk about, well, why should you do it if you're not doing it? And if you're doing it annually, what changes do we recommend that you make? So with that, well, what is a budget? What is a financial forecast? So a budget is an outline of expectations of what the company wants to achieve for a particular period. So typically a budget's a 1-year period of, hey, these are the things that we want to achieve. A lot of times a business that doesn't create a budget, they're always comparing themselves to last year. So when I call a client and I say, hey, how are you doing? Either they're going to tell me how they're doing compared to budget, if they budget, or they're going to tell me how they're doing compared to the prior year. And for me, that means that they want to do exactly the same as what they did last year. A financial forecast looks at a longer period, and it looks at, hey, what could an outcome be based on historical data over a much longer period, say 5 years. So how do they differ and how are they alike? So a budget is created to meet a goal. So such as a lot of people on this call today do annual, but you might have a quarterly goal of I want to increase revenue. I want to have X percentage growth. The budget tells you where management or owners want to take the company within a specific time frame. Again, typically a year. or it's your fiscal year if you have a fiscal year. Your financial forecast is examining the budget's targets and saying, hey, can we meet this based on history during the proposed time frame? So while a forecast paints the big picture, usually in less detail, the forecast is typically less accurate than the budget because it's a longer period of time. It tells what you want to achieve based on the factors involved, while budget is step-by-step detailed financial plan showing expectations for revenues and expenses over time and how that time frame is going to help you meet your forecast.
So Nikki, one of the things that I always like to tell my clients that seem to make a little bit more sense when I try to explain a budget in a forecast or a budget in a pro forma, a budget is where do I want to be? And a pro forma or a forecast is where am I going to be? And so one is, this is what I'm going to try for when I set it. This is where I want to be, but based on everything, this is where I'm headed.
Good.
So sometimes that helps people think about it a little bit because they are different.
Good. All right, next slide. So where do I start? So the 14% of people that said, hey, we don't do a budget, it's probably because you don't know where to start. And when you just sit down at a blank sheet of paper or a blank Excel template, it seems a little cumbersome. So without a forecast, you'll end up spending resources and going down a path that maybe you didn't want to. It's not aligned with your overall business financial goals. It's not aligned with your 5-year, your 10-year plan. So you need to start with a forecast. You need to know, hey, where do we want to take this business? Where does it look like this business is going? And then you need to create the budget to say, okay, within this period of time, typically your calendar year or your fiscal year, here's what we want to do in order to meet those objectives. So you need to make sure that both are aligned in order to get there. So if you don't know where you're going in 5 years, in 10 years, then you really don't know what you need to do this year. So that's where you should start with the forecast. And here's an example of what that looks like. So now this is a very aggressive growth company. So a startup type company. Look, they want to get from $1 million to $26 million within 5 years. So within this analysis, so this is really the cover sheet to your forecast. And it really says, here's the snapshot of where this company is going to be. Now, behind that, you're going to have expectations and you're going to have analysis on how you're going to meet your revenues targets. You're going to have analysis over what your cost of goods sold are and what assumptions did you use when making these. So you don't just sit down with a blank sheet of paper and start filling in numbers. You really look at, hey, what historical data can we use to help us predict what's going to happen over the next period of time. And you want to document those expectations and those predictions that you have made. So when you go back and look at it, you can say, well, why did I think we could hit this target? You're better able to understand. And if you have new people coming and going that are helping you meet your goals, they can understand what parameters went into you making these decisions. So this is just a simple forecasted income statement. You will see, I'll show you an example of a budget later. This is a lot less detail. So again, and this will be it will not be as accurate because it's such a long time period. So if you don't know where to start somewhere here. So budgeting and forecasting has always seemed like a complex project. So when you sit down in November, December to do it for the next year, I get clients saying all the time how much they dread it or how much time it takes or how much work it is. And this year it seems even a little more daunting. You have to consider things like the potential economic downturn. What does that mean to your business? The post-pandemic demand shift. So was that a positive demand shift for you? Was that a negative demand shift for you? What do you think that looks like in your future? inflationary pressures. So a lot of people on this call, or the majority of people on this call, said, hey, we do annual budgets. Well, I'm going to tell you, if you take away one thing from this call, is to do monthly budgets. And because we're facing so many things like the inflationary pressures, the supply chain shortages, raising interest rates, that if you're only looking at it one time per year, you aren't able to make intelligent changes, educated changes. So inflationary pressures are going to raise our prices. Supply shortages are going to raise our prices. So are we hitting the margins that we're looking for? Nancy will talk about some key indicators in a little bit, but rising interest rates. So, get out your bank loan. When does your loan come due? You might go from a 4% interest rate to a 7.5% interest rate. What's that going to look like? You need to be planning for these things, and you need to know how it's going to hit and what it looks like within your budget.
So one of the things too, Nikki, because so many people on the line do annual budgets, I think doing a monthly budget might seem overwhelming to them. So I think the easiest way to start is to take your annual budget and just divide it by 12. And once you look at that, you're going to know if you have any cyclicality to your business. You're going to look at that and know, well, I can't do, $1 million in June. That's just not realistic. So then you can start to make some adjustments to those months during the year where you have some cyclicality to your business, and maybe you have operating expenses that are due quarterly. You can then change those and say, okay, I know I pay my real estate taxes or my CAM, whatever it is, in February and in August. So you're going to make adjustments there. But that's probably the easiest way to start, is to start with your annual divided by 12 and then start to look at every month and make changes. Because if you try to do each month independently, it will feel completely overwhelming. And you probably won't get to what you thought your annual budget would be. So that's probably the easiest way to start.
Perfect. And that's what I do too. And you can, if you have a seasonal nature to your business, and you probably have a good idea of what those numbers are. They probably change a little from season to season, but you can use historical financial statements for that because the percentages are probably fairly accurate. All right, so we talked a lot about looking at history to predict the future, and while we'll still do that, we do have limited history related to the current economic climate where we're at. So what does that mean when you're looking at budgeting and forecasting? Is really you still need to use historical data to try to predict the future, because that's really the only thing we have. And it's still a factor. You just need to put a little less weight on that factor and a little more weight on the things that you think are volatile, and not just rely on history to predict what your margin might be, or what your expense might be, or what your sales might be, given that. So really the past has been atypical. So if we look to 2019, 2020, 2021, 2022, for a lot of businesses is atypical. And some of the same businesses have seen the highs and the lows within that period. So where are they going to level out at? Also think of the relevant factors, such as to help you predict what the future might be, as far as interest rate hikes tend to deter lower priority investments and those that require debt financing. So let's say if you're a contractor, what does that mean? Or if you're selling heavy equipment, what does that mean to your sales? And so if you go back and look at history, if you've been around long enough to identify, well, this is what happened last time we were in this type of environment. And then also review the behavior of certain industries or activity in response to disruptive events. So if we, based on our current, if we go into recession, what happened to your business last time we were in a recession is a good thing to look at, to give you an idea of where you think you're going to go, what's going to happen to your business during this time frame. So why do I even do a budget, and why do I compare to actual? And why is that monthly so important? So right now we're dealing with a whole economic climate that history hasn't provided to us before. So we have workplace volatility. So you think about raising costs of our employees. That's one thing that we hear as a number one problem, and that will remain the problem. But then the other thing is, what if you can't even get the employees that you need to do your job? So how's that going to alter your revenue? What does that look like for your business? Something you need to think about. Slow movement of raw materials and goods. There are still border restrictions, so you just can't get something. So what does that look like within your budget? What does that look like for your sales? Increased inflation and shipping costs. So this is why we're looking at it monthly. If we have a product that the cost is increasing dramatically, maybe we can switch to a different product from a different vendor. Before, we used to say, hey, always try to stick with one vendor. Well, not necessarily the case anymore. And then manufacturing facilities are facing more protective policies. And what cost does that have to the facility? And how are you going to put that into your forecast? Because I don't think it's going to decrease. It's not going away. It's only increasing. And then how are you going to budget for it for the next year, of those costs? So there's so many reasons why we need to do this. So here's an example of a budget, and I know it's small, and don't get too worked up on the numbers, but it's really just an example. So this is an annual example. Okay, some of you do an annual, and maybe yours looks like this. So after you close out the year, you put in your actual and you do a variance, and you say, how good was I? Now, I want you to take this one step further, because I actually want you to do it on a monthly basis. So every month you're going to have a similar, like Nancy said, you're going to go break it out by 12 and adjust it. And then you're going to have a similar. So hopefully you close out your financial statements shortly after month end, and you're able to put the actual numbers in there and then look at that variance. So that variance is really important. So just to do a budget and not to use it, is it really worth anything? So it got you thinking about where you want to go and your goals, but it's not helping you say, am I achieving those? So if you look at that variance and you say, okay, my sales are down, my cost of goods sold are up, well, there's a problem right there. Okay. So typically our cost of goods sold move along, they're variable with revenue. So then you're able to make decisions on, do I need to increase prices? Do I need to go through and cut expenses? But without doing a budget and without doing a monthly, it's, if you're only looking at it annually, it's too late to make changes to make sure that you're meeting your goals.
So Nikki, one other thing too that I have a lot of clients that do is they put budgets together by department or by location or by service line, because then they can also hold management responsible. So if you have 4 different departments in your company and you have different leadership in each department, you want to make sure that you have a budget by department so you can hold that department leader accountable for that particular budget. So they're not flying blind. It's very difficult to have somebody be accountable without having this information provided to them. So I think it's good to even take it one step further than we've talked about here and go down to the department level. And then one other thing, and maybe you're going to touch on this, but I think it's also important for people to know that budgets don't change. Once you set a budget, the budget is set in stone. Then you just record, as Nikki's got the variances here, you might have a notes column that's explaining why the variances occur. But a budget isn't going to do you any good if you change it every month based on what's happening, because then you have no way of knowing, how am I off from what I was predicting to happen or hoping to happen. So it's important that people understand budgets don't change from month to month.
That's good. And a lot of times performance bonuses are, hey, did you hit your budgets? Did you hit what we said we wanted to hit? So that's a good. All right. So how often should I look at this? So forecast, you need to look at a little less, right? Because it's, typically a forecast is typically 5 years worth of data. So you don't need to look at it. You're not going to forecast every month, and you don't need to look at it every month. So quarterly, more often you'll see people looking at their forecast annually to see, is your business headed in the right direction? Are you going where you want it to go? Are you going where history probably says that we should go? And if not, why? Budgets, monthly. That's probably the one change that you're going to see is before business owners, because they knew where they were going. Not so much anymore. So monthly is important because items that weren't volatile before have suddenly become volatile. So you used to know what expenses were volatile, where you had your price increases, but now it seems like the most unusual things are volatile. So you need to look at it on a monthly basis, and then you're able to make educated decisions on managing the company, and more importantly, managing the bottom line. So I hear people say all the time, well, I just budget. I want to hit $8 million worth of revenue this year. Well, that's great. But, we want to work smarter, not harder. So we want to budget those expenses and know where our bottom line and where our cash flow is going to come out at the end of the year, and make sure that happens. Another thing, if you take out of this, is to put a little stress test or what if scenarios on your budget and on your forecast. So since we can't predict the future, and we know sometimes the future will throw us a curveball, after we do our forecasts and budgets, I want you to change the factors. So within there, I said you'll have estimates, you'll have things that you think are going to happen. I want you to document those and then think about what could possibly happen. So we know interest rates are, going up. Some people are even seeing 7% plus. What if interest rates went back to how they were, in the 70s, 80s? What if we were at 20% interest rate? What would that do? Now that's an extreme example. But just to think about it, some people on this call might be able to relate, to think about it and say, okay, well, if this happens, this is what it's going to do to my forecast. This is what it's going to do to my budget. And why would you do that? You're really going to do that so then when these items come up, you know how to react, and you know what's going to happen to your financial statements, and you're able to make and plan accordingly. So let's say if for some reason your cost of goods sold goes up 25%. Well, if you stress tested it, you knew what that meant to the bottom line. Once you start seeing those costs coming, you're able to say, oh, we got to push this along to our customers. There's many instances of where some expenses will go up, that if you put a little stress test on it, you're going to be much more suited to handle it in an educated format. So it's going to be best for the business and best for yourself, because it's kind of like you have a plan for the unexpected. And not a lot of people put stress on their budgets and on their forecasts now. But that's one area, if you take anything out of here of what you could do different, that's really going to put you in the driver's seat. So how do you review and, better yet, lower your supply chain costs to meet your goals? So first off, knowing your costs. There's many people that just don't even know what all the costs are associated with their business. So when you go through the budgeting process, it really makes you take a deep dive into what are your expenses, what increases are you anticipating before they happen. So it gives you a much better understanding of your business expenses. Take advantage of discounts. Not all discounts should be taken advantage of. I guess that's my little caveat. Some discounts are good for businesses, some are not good for businesses. So you really need to look at the cost benefit of that. And a discount that's good for one business isn't good for another business. So you can't hear a business like yours taking advantage of a discount, and doesn't necessarily mean that you should take advantage of that. Focus on fewer products. So I've seen this happen a lot over the last couple of years where people focus on their core products, which helps you manage those products and what you need for those products. Stock core products. So like we said in the last presentation, typically we wouldn't advise you to stock products necessarily, just-in-time inventory. However, we know that just-in-time inventory isn't necessarily the case. So how much should we stock? Can we stock? Can we get discounts for stocking? Or more importantly, make sure that we have a product to sell. The only caveat there is that we want to make sure that we're not stocking at a high cost and selling it at a time when that product is a much lower cost. So we don't want to stock too much. And we also need to look at, will that product go obsolete in the time frame that we intend to use it? And if there's any probability that it will, stocking it is not a good idea. So know when you can absorb a cost and when you need to pass it along to your customer. Again, you don't necessarily want to see that dip and then decide, hey, I need to pass this along to the customer. If you've stress tested and if you know what your key parameters are within your budget, you know, hey, if this is coming along, this is what it's going to do to my bottom line. I need to pass along to the customer right away. So you're really able to anticipate that that's coming along. You know what you expected that cost to be. A lot of people don't even know what they expected that cost to be. If you're delivering products and shipping is included, you can increase your delivery minimum to make sure that the cost is worth it on those items. And renegotiate contracts. So are you in a lease? Are you in an operating lease? What kind of contracts are you in, and can you renegotiate those to get those to a more appropriate level? You will be probably facing renegotiating contracts as far as your loan documents go. So what is the structure of that, and what are the terms that you're looking for? How long are you locking the interest rate in? Is there a prepayment penalty? Are all things you need to think about when we're in a increasing environment. You know, can you get out of that contract? Can you renegotiate it throughout the period if those interest rates come down? All right, we're going to do another poll question. So how many key performance indicators, KPIs, do you track regularly? 1 to 2, 3 to 5, 6 to 9, 10 or more, or we don't track any. All right, so it's looking like 3 to 5 is the most, but it looks like the majority of people are tracking some KPIs, so that's great. So with that, I'll hand it over to Nancy.
Yeah, that's great. Thanks, Nikki. So I think before we go into KPIs, metrics, benchmarking, I just want to make sure everybody even understands what a KPI is. So a KPI is key performance indicator. It's just a quantifiable way to measure the success of your company. There are so many different ones, and I'm going to go over a few of them, but this is just the definition of a KPI and why it's important to do that. And so there are things as financial KPIs, and then there's operational KPIs. They're very different, but they're still evaluating and measuring the success of a company within that area of your organization. And I'm going to go through a couple of different ones, examples of different ones in both places. So now I want to talk just the definition of what a benchmark is. So a benchmark is really a way to evaluate your company against other companies. So you can really use your KPIs to benchmark against other industries. And I know a lot of people are wondering, well, how do I do that? There are a lot of subscription-based programs out there that can do this. that you can ask for benchmarks based on an industry, based on a location, based on revenue, number of employees. We use some here. We use a program called RMA. We use something called the Value Builder that has all those benchmarks. And you can also ask any financial professional, because they would be able to provide you those for your specific industry. So two different things, but it's important to understand both of them. So why are these important? Well, they're important because it's going to give you a competitive advantage, and it's going to allow your entire firm to be working towards the same goal. You want to understand, when you're looking at benchmarking against other industries, it's going to help you identify what the strengths and weaknesses in your company are. There's no sense in spending a lot of time and effort on a specific area in your company if that's a strong area. You really want to focus on, where am I weak? What particular area do I need to focus on, and how can I continually monitor that to make sure that I'm meeting my goals and my metrics? So some examples of some financial KPIs, and I'm sure that a lot of people have seen these. And again, there are so many of them. You really have to figure out which ones are important for your company to track. You have a current ratio, there's a quick ratio. These are very easy to calculate. Current ratio is really just current assets divided by current liabilities. And then there's indicators on what is a good current ratio, what is considered a good quick ratio. You know, one of the things people look at is days in receivables. There's also a days in payables, which I don't have on here, but one goal of yours, and what I would suggest to people, is that your days in receivable should be lower than your days in payable, because you want to make sure that you're collecting the money quicker than you're paying money. And looking at something like a days in receivable is going to be important, because it's going to give you an indication if there is a specific client that could be slipping in payment. Because with everything going on right now in the world, I know that everybody's struggling a little bit. And so you want to make sure that you're working with your customers, and you don't want to wait till it's too late. If you have a customer that you're supplying a product to, and they haven't paid you in 90 days, you probably don't want to continue delivering a lot of product to them until you figure out what's going on there. So it's going to require some communication. But again, you need to know these KPIs, because if you didn't know these, you're not going to understand, and it's going to be too late before you can make an impact or make any changes. It's also very important to understand what ratio your bank might be looking at. You know, Nikki just made the comment a little while ago about looking at bank contracts. And this is important because banks have things that they call covenants. And so if you have a loan out there, you could have a bank covenant that says that you need to meet this specific ratio. And it's important to know what those are and to track those, because you don't want to be in a situation where you're failing a bank covenant and you don't even realize you are. And then the bank calls you up and they say, you know, we have a problem here. So you need to be monitoring those. So I think for every company, these are going to be different what you look at. And you're going to want to monitor the ones that are important to you. You know, liquidity ratios could be that looking at current ratios, quick ratios. Those really tell you how liquid is the company? How much assets do I have that I can quickly convert to cash? So that's why those ratios might be important if somebody has cash flow issues. So this is just an example of some of them. And like I said, there are a lot more. So one of the metrics, this isn't really a ratio, but it's a metric that I want to talk a little bit about here, is a gross profit margin. And I'm sure that if you've been on any of my other webinars, I say this is probably the most important number on your financial statement that everyone should know. And I'm surprised how many times I meet with a new client and I ask them, what's their profit margin and what should their profit margin be? And they don't know. Every industry has a benchmark on profit margins. It's very, very important to know what that is for your industry in your area. Again, you're not going to want to be comparing that to maybe somebody in Wisconsin to a company in California, because things could be very different regionally. So you want to make sure that you're looking at that within your region, but you need to understand what that number is. And I'm going to give you an example of why. And the other thing that does is it helps you understand something called incremental gross profit. So if your company has a gross profit margin of 20%, that's industry average, you're hitting that, or you're at 25%, but you have capacity and you have the ability to take on maybe a large job because you have capacity. You have to understand that there's this thing called incremental gross profit, which is going to be a lower gross profit margin intentionally to bring on more revenue to the bottom line. One of the things that I've said before, and take it with a grain of salt, but in some situations it's very applicable, is would you rather have 50% of a watermelon or 50% of a grape or 10% of a watermelon? That's kind of that incremental gross profit. So don't get too hung up on getting below that number if you have the ability to take on maybe a large job at a little bit smaller profit margin, but it's going to bring more to your bottom line. So it's important that you understand gross profit margin and how it affects your company. So as we look at something, I want to show you an example of something called a break-even analysis. So I like to do this for all my clients because I think it's very, very important for every company to know, what is my sales break-even number? And really that is just, what do I need to bring in to cover my overhead at my average gross profit margin? And that's why that gross profit margin is very, very important. So if you know that you're at a 50% profit margin and you know what your overhead costs are, you can back into that from a sales perspective at what do I need to bring in on a monthly basis, on an annual basis in sales to really crack that nut of covering my overhead. This is an extremely important analysis. And I want to give you an example of it. So here's a really simple example. And this is where Nikki's budgets can really help out when you're looking at expenses. What do you can kind of use your budget as a format, and you also want to look at historically, what are my operating expenses historically? So in this particular situation, you see on the right here, I have these assumptions. So these would be like input fields. And let's say that my assumption is that I have a 38% gross profit margin. I want, as an owner of this organization, I want to take $100,000 salary, and I just put a profit goal at the end of 100,000 of $1. You could put in 100,000, 200,000, a million, whatever you want to put in there. And then one of the things that I like to do is if you're a company that sells any type of unit, in other words, it could be a personal service company that's selling hours. I've done this actually for a chiropractor. We look at the average number, the average cost of an adjustment and the average number of adjustments, and you can actually back into how many adjustments do they need to do in a day to break even. So what this does is once you put your operating expenses in, you have your profit margin, it's just going to automatically calculate what the revenue needs to be in order to hit those marks. So in this particular instance, this particular example is $2.6 million in total revenue they need to make $1. So that's basically going to be the break even. If their average unit is $1,250 per whatever they're selling, again, this could be a product, this could be a service, then that means that they need to sell $2,088 to break even. So this is also a great tool to use for bonuses, because if you have, again, a department or something where you've calculated this, I had a client that said to their employees, it was a retail product that they sold, and they knew that their break even was 5 units a day. And they said to their staff, anything over 5 units a day that we sell, for every additional unit that we sell, everybody's going to get $50. And so it was really easy to monitor that, and it's easy to incentivize. I've had people say, if we meet our goal in a week, our break even in a week, everything over that, we're going to have a pizza party on Fridays. So there's simple things that you can do, but this is a number that you want to make sure that you're taking a look at and you know what that number is. So this is actually a very powerful tool, and I encourage anybody to try to make it work within your business. So the next thing that I want to talk about here are operational KPIs. So operational KPIs are not necessarily driven completely around financial metrics. Revenue growth, this could actually be considered both a financial and an operational, but looking at revenue growth and what's the formula, if pretty simple, if you just want to know what is my growth month over month, year over year, it's a pretty simple one to do, but again, something you probably want to monitor. Your revenue per client, again, very easy, but if you want to see, if your goal is to have a smaller amount of clients, but sell more to those clients, then this becomes an important number because this aligns with your goals. So again, you want to pick KPIs that align with the company's goals. So this would be a good one. Another one that I find is very, very important, client retention rate. You want to make sure that your retention rate is consistent and that you're not losing clients. So that's an important one. So how do I manage client and employee satisfaction? This kind of goes to the client retention rate, and you can do the same thing for employees. One of the things that I recommend is people take the Net Promoter Score. So I don't know if anybody has heard of this, but I'm sure everybody on this call has gotten those emails that says, on a scale of 1 to 10, how would you rate my product or services? Or how likely would you be to refer my services to family or friends? And that is the only question, and you have 1 to 10. There is a program out there called the Net Promoter Score, and that's all it is one question. People are more likely to answer a survey if it's only a question. And then there's a formula. You have anybody who scores you a 9 or a 10 are going to be the people promoting your company. Anybody that scores you at a 7 or 8, they're going to be considered your passive customers. So those are going to be customers that they like you, they like the services you provide, but they can be easily swayed by a discount or offering something free. They're going to be swayed somewhere else. And then, believe it or not, anybody from a 1 to a 7 are going to be considered passives. And what you do is you add up and you subtract your 7s and 8s from your 9s and 10s to get your score. It's important that everybody knows what that is. One of the things that I also tell people is you have the option when you're giving a Net Promoter Score to say optional and say why. Because sometimes it doesn't do you any good to know that you scored low if you don't know why you scored low. And so people have a tendency, if they're dissatisfied with something, they have a tendency to want to tell you why they're dissatisfied with it. They won't just say no without wanting to explain why they say no. Or I'm dissatisfied. So I think having the optional on there gives people the ability, if they give you a 1, to tell you why, so you can then focus on that. This is something that I recommend people do every year. Sometimes companies do it more than once a year, but once a year at a minimum. And you can actually do the same thing with an employee satisfaction. There is an employee Net Promoter Score. The other metric you might want to follow is your employee turnover rate or absenteeism rate. So if keeping employees and retaining employees is a problem or it's something that you want to focus on, then this is one of the standards, the KPIs that you probably want to really keep track of. So I think really what it boils down to is it really boils down to what is the most important KPI for your company. Do you have a dashboard, or do you have a report that continually shows this? A lot of programs out there now offer dashboards. I encourage you to look at whatever system you're using to see if they have a dashboard and if that dashboard can be programmed with any of these KPIs or these metrics that you want to measure. Now, again, some of these, because they're not financial, may have to be done outside of your financial software. But I think it's important. One of the partners here had mentioned to me and given me an example of what she does for her clients is called a flash report. And I think that's a great tool too, because that gives you the KPIs that are important to you that your accounting financial professional can put together on a monthly basis. So I think it's just helping you determine what's best for your company. And then how do we get started on measuring those? And what is the benchmark that we're looking at? So I know I went through that fairly quickly, but there's a lot of information, and we are here to help you and provide you with any of those metrics, KPIs, and benchmark those against other industries if you'd like us to help you with that, or to put together a break-even analysis. So looks like we have another poll question. Oh, and how many of you have software that has a dashboard? And I know that there are softwares out there right now that are just dashboards and analytics that you can add on to, you can piggyback onto, like a QuickBooks. If you have QuickBooks, for example, or a Sage program, you can just add those. Oh, wow. So almost 50-50. Pretty good.
All right, well, let's, we're at 12:46, which means we're already a minute over, but Nancy and Nikki, some great information. We've had a couple questions come in. If you do have any questions, please chat them in now. We'll take one or two, but then get you all on your way. One of the ones that just came in the last couple of minutes is, I feel like we're suffering from paralysis by analysis. How many KPIs are too many? One of you want to take that one?
Sure. Again, I think it depends on what are the weaknesses of your organization. You want to focus on the areas where you have weaknesses in your organization, and you want to continuously measure those. And if you have a goal and there's a metric that surrounds your goal, I don't think that every company needs 50. I don't know that every company needs 25, maybe 10. And those 10 might be broken up between departments, between groups. I think you have to look at, again, every company is going to be different, and what they're looking at is going to be very different.
And typically I always say, if you're away and you can only look at one sheet of paper, how are you going to know you're on track? And if those are the key indicators that you're going to put on your to-do list.
Oh, that's a great point, Nikki. Yeah. If you only had one piece of paper to look at, what would be on it? Yeah, that's a great way to think about it.
So Nancy, we have a question about benchmarking. You talked about this a little bit at the beginning of your section, but this person says, and I don't know what industry they're with, but it says, we found benchmarking to be difficult because we don't fit into a neat little industry. What are our options?
Yeah, you do have to be careful. And sometimes there are generic benchmarking that you can look at, but you have to be careful at what's in there. And that is one of the things that, I'll be honest with you, one of the things that I struggle a little bit with benchmarking is we get this information, but we don't always know the background. And one of the things that I probably had on one of my slides that I rushed through, I realized, is making sure you're comparing apples to apples. So if you're looking at a gross profit margin of 30%, what is in your direct costs that get you to 30%? You want to make sure that you're comparing. And this is where I think it becomes important to have an organization that knows different industries and knows what's in an industry average. Like Nikki could probably tell us in the hospitality what those numbers should be like that. And so having some industry knowledge, I think, is important when you're looking at benchmarking, because if you're just going out there and grabbing it from the World Wide Web or some program, you don't always know 100% of the accuracy of those. So it does become difficult, but it can be done. I think you just have to be careful at where you're pulling information. And actually associations are great. You know, there are associations for every industry. I used to have a client that sold Trek bikes, and there's actually like a Trek bike association, and they provide benchmarks for dealers of Trek bikes around the world. So looking at organizations, associations could be very, very helpful for getting that in a very niche type industry.
Great. Well, Nikki and Nancy, again, thank you. So a lot of information shared, some really great tools. Thank you for all that. As we wrap up here, I just want to let everybody know that you can go to svaaccountants.com/events to sign up for our other upcoming webinars. We've got our next tax update coming up on November 30th, and it's going to be talking about the R&D tax credit. If you've taken the R&D tax credit in the past, you should attend. You got to learn about how the new tax credit rules are going to affect you. Then we've got our next economic impact series webinar coming up on December 6th. And the topic there is why valuations are an important tool now. I just want to remind everybody that the SVA team is only a phone call or an email away. So if you're a client, please reach out to your SVA professional as questions arise. And if you're not currently an SVA client, you can contact me, Lee Schwartz, so I can get you the help or the answers that you need. Thanks for attending today, for joining us, and hope you have a great rest of your afternoon. Bye-bye.
Bye.